Welcome to episode 35 of the Corporate Real Estate Insider podcast, back with another episode. We have a really wide range of topics that we're covering today. So to start off, guys, there just was this major real estate conference in the South, and one of the real estate partners at KKR came out on a panel and said, hey, look, there's actually a major shortage of premium office space, and this demand for premium office space that is, more depressed now than certainly it was before, that it's coming back and that owners need to be patient and that the market is going to realize that there's actually a meaningful shortage of premium office space. So I wanted to start off, I of course have my own opinions on this, but I wanted to start off and ask all of you, do you actually think that there is a shortage of premium office space? Or is it simply that there isn't a 2x abundance of obsolete Class B space like in these other categories, and that Class A space just looks a lot healthier? But is it actually a shortage? I'm really curious what everyone thinks. Let's jump in and start there today.
It's very interesting, Tucker. In preparation of the podcast today, I've been digging into the first quarter results for all of the major real estate firms. It's always interesting how they present their financials and also just their outlooks on the market. And what I found interesting that ties into this topic is what the CEO of JLL has said around this particular item. And I'll quote, "In leasing, we expect a strong demand for high quality, sustainable space to continue, and due to the shortage of this type of space, to drive an increase in rental rates." So JLL is predicting rental rates in high quality premium space will go up due to the same shortage. And I want my personal opinion, and I'll talk more about what CB said on the issue, which they use the term leasing outperformed expectation, driven by office leasing growth that reflects a resilient economy and companies making progress, keyword progress, on bringing people back to the office. I think first and foremost, I think there could be a short-term shortage on this type of space because many companies have not had their leases roll and they haven't made the decisions on what their offices of the future are going to be. So there's demand that's shifting to high-quality buildings, and many of those buildings had been leased up during the run, and those leases just haven't expired. These high-quality buildings that have been delivered in the last 5 to 10 years, if you were to do a lease in them, minimum 10-year lease, likely pushing for even longer in some markets like New York City or Boston. So you've got a tail on many of those leases that are longer than where we sit today. New tenants are looking to trade up into higher quality space because they've been able to unlock savings by downsizing and becoming more efficient. Therefore, as they look at the marketplace, there's a lot of probably buildings that have low occupancy, but not low availability or vacancy, providing the KKRs or the JLLs of the world the ability to make those types of statements and kind of hold on and hope that, rental rates are going to increase, the market's tightening, and it's a story I just think is not going to hold up over time.
Tucker, the statement seems a little bold to me, but let me explain kind of my thinking. The result of this, and this is a comment really for, let's just say this is knowledge for the tenants, but advice for the landlords, is I'm going to phrase it. And it's coming from me, so don't take it to the bank, but it's just my experience after 20 years of doing this. The results of downtown are going to change. That's inevitable. And it's unfolding right before our eyes. And every downtown in America of any sort of major city is about to get recalibrated. And it's already in that process right now. Some may just not even realize it. And what I mean by that is 20 years ago, when I got into this business, any, master plan for a metropolitan market across the country would be based on the central business district. That's what it was like here in Seattle. And that's what it was like predominantly in New York, where the financial district was its core. And everything revolves around it. Well, that's changed since the pandemic. We've had 4 years to adjust, and we've got many years ahead of us to adjust. But the city center, I believe, is going to be based off lifestyle going forward. And what I mean by lifestyle, talk about entertainment, amenities, rather than just simply the financial district or using business as its core. And so think about this. I think we've talked about this on previous pods, but the average lease term for an office lease in Seattle ranges between 5 and 7 years. Okay. Now there's certainly the larger companies tend to lease space for 10 to 15 years. The smaller companies tend to lease space for 3 to 5. And so the median is probably thereabouts between 5 and 7. In New York City, the average lease term is 10, and in London, it's 12. Okay. So the reason I raise this is that on any given year in Seattle, let's say 20, maybe 15% of leases roll. Okay. In New York, 10%. In London, less than that. We're talking like closer to 8. And so it takes many, many years for these cities to right size based off of what's actually needed by the people that occupy these spaces downtown. And so we're only 4 years into this thing. And the reality is for everybody, whether they want to accept it or not, we're not, nobody's putting the genie back in the bottle. People have become set in their ways that there will be some sort of a hybrid workforce. And so as to KKR's comment that there's a shortage for Class A premium space, that might be the case in certain submarkets throughout certain cities. But keep in mind, when define Class A like premium space, in Seattle, there's 7 buildings downtown that I would say are true premium assets. There's many, many Class A buildings that are borderline commodity. And so, I think there's going to be this massive oversupply of average spaces. And so to some extent, the KKR gentleman might actually be accurate in the sense that, if one can build a premium asset in the right part of town, which might no longer be the financial district, there might be a severe shortage. But there's going to be a massive oversupply of average buildings. And I would even classify some Class A buildings as average. And so I guess I don't mean to like not stick an opinion on his comment, but I just need more data. I need to understand kind of where things are coming from. But the reality is this: if you're a landlord or a developer, you have had, 4 years to kind of see how this thing's unfolded. And I would suggest you've got a few more years, 3 to 5, to adjust, because the market is going to continually get worse, in my opinion, worse for landlords. And I don't celebrate that. We're all in this together, right? That just means a lack of activity for the whole market. And that affects those that do what we do. It affects lenders. It affects landlords. I mean, the whole big world of commercial real estate. But in my opinion, the future is inevitable. And I think there will be a need for some premium space, but it's going to be dependent on where it's located, because where it might have been located 10, 15 years ago might be the wrong spot.
I agree with everything you just said, Owen. It's funny, you hit most of the points I wanted to bring up. It's like we are going through a major structural societal change. And it's like an earthquake. It's like we're in an earthquake. And here we are trying to predict if our house is going to hold up, stay together. We're running around and checking the bedroom. We're checking the living room. The ground's still rumbling. This is still playing out. It's too early to make the call, but there's going to be damage done, and it's societal. We've talked about it before. So the other point I wanted to make that Owen just made is when we talk about Class A or Class B, more and more, one of the key drivers of, high demand space is going to be not just the quality of the environment, but the location of the environment. And we've said it before on this pod. I'm of the opinion that it's really the major metropolitan centers that are most at risk when we shift from this sort of old way of thinking, like everyone go to work there. No matter where you live, we're going to go to a singular location to be on our computers there instead of here. And that's just going away. The reasons we come together as a team is to be with the team. We're going to spend some time on the computer, but we're going to spend more time with the team. So I think the idea that we all just went down the same freeway to the one place where all the jobs were stacked in a high-rise or a market of high-rise office buildings is fundamentally being challenged. And location, it's funny. I was out in my market and drove by a building the other day, and the parking lot was crowded. There was no parking. And I thought, how unusual. But remember when that was the norm? And then here's this, and I'm looking around who's the company that's jamming in this? And their warehouse was overflowing. I was kind of excited to see it, but it made me realize how unusual that is now. I just think we're going through a societal change about the way we work and how we use office buildings. And we end up with lower demand overall and less concentration in singular downtown markets. I'll share an article. This speaks to this in an indirect way. The date, May 7th, 2024, from CoStar. Office space reduction sets record pace in first quarter, JLL says. U.S. office inventory reduction, including conversions to residential use, has increased each year since the pandemic and began in 2020. New data from the first quarter shows 2024 poised to extend that trend, with more square footage taken out of the inventory in the first 3 months of the year than the long-run yearly average. Nearly 90 million square feet of office space was removed in the first quarter, outpacing new supply for the first time on record. The level of removals is more than 11.5 million square feet larger than the yearly average that was for that quarter, is larger than the yearly average going back to 1994. Like, we're getting rid of office buildings, either by tearing them down or by converting them to residential, because we're going through a societal change and we're still in the middle of it. I agree with you, Owen. Not only do we need more time for leases to roll, but some of the leases that already have rolled, those folks did sort of short-term Band-Aid 3-year, let's just renew and watch this play out. If you think about how many companies have made bold declarations only to reverse course, like, it's not settled. We're still in the earthquake. So we need more time. I'm with Owen.
Yeah, I think really what it comes down to is, how do you define premium office space? And I think that when most people think of premium office space, they're more focused on characteristics of buildings and they're less focused on the building as a whole, right? I mean, it's very common that in Los Angeles or the other markets that I work in around the world, where landlords will say, hey, look, this is one of the nicest buildings in London or one of the nicest buildings in Detroit or wherever, right? And that may be true, but usually it's a comment around the physical components of the real estate itself as compared to the overall attractiveness of the office building as a whole. So going back to what this KKR real estate partner said of, hey, there's actually a shortage of premium office space. If you define premium office space in the perfect definitional way, yes, that can be true. But we are way oversupplied for Class B office space. We're way oversupplied for Class A office space. And there's basically no disputing that at this point. Are we actually oversupplied in terms of premium office space as defined by the top 1% of most attractive buildings in each market, where, the really high-end bulge bracket banks are going to locate, or different financial service companies, like you think the, JP Morgan's, Goldman Sachs of the world. So, like, where are they going to select to have the, prime real estate for their really, coveted, hard to recruit, hard to retain types of talent, or, Apple, Meta, all those different types of companies. Are we actually in a shortage of supply? I would say that we aren't. I genuinely don't think that we are. And that's based off of having large requirements ongoing in over a dozen different major US cities right now. And when you think about that, you don't need 30 or 40 options if you're a 50,000 square foot user to run a compelling or a competitive real estate process. You maybe need 5, or really you probably only need 2 or 3 that are actually really attractive. And in many of these markets, there's legitimately well in excess of a dozen great options for these either financial service type companies or these technology companies to consider. It's only when you get into either extremely large, in which case you're probably doing a build to suit anyways, or very niche, like, hey, I need office space, but I also need R&D component that requires dock loading or something that is uncommon. That's really the only time where you run into, hey, there's a shortage. And it's less a shortage and it's more, you just have really unique needs. The other point that I wanted to make here is that if premium office space is actually in short supply, think about how the market's going to adapt to address that need. And then think about how small the, definitionally correct premium office space market actually is. If you're saying that the top 1% of the nicest office space in any given market is in short supply, well, guess what? Everyone's going to rush to deliver more product like that. We have a very long history in this commercial real estate world of over delivering on the current supply that's in vogue. And when you're dealing with a supply that is a fraction percent of the overall square footage in the market, it doesn't take that many buildings or that much space delivering to double or triple the amount of inventory in that particular area. And imagine if you're dealing with a really supply constrained market and demand is relatively constant, all of a sudden you double the amount of supply that exists in that market. that is really bad for pricing power. So I could see a similar type of environment to life sciences happening for this premium office space, where maybe there's pricing power now, but the market's going to adjust, going to deliver more of this product, and the pricing power is going to erode as more supply comes to the market. And that's crucially assuming that we're actually in a shortage of supply. Nothing worse than everyone thinking we're in a shortage of supply, going and delivering more space based on that shortage. And meanwhile, we were never in a shortage ever. So anyways, those are my thoughts.
Yeah, and I think this also excuses the fact that what about those buildings that go back to the lender? You know, if people are trying to create something unique for themselves and their team, you know, let's just take an example like an Art Deco building. You know, something that is reminiscent of the 20s and 30s. You know, you obviously have more on the East Coast than you do on the West Coast. But what if somebody bought one of those buildings out of foreclosure at an unbelievable discount, much like those we've talked about on previous podcasts, like this transaction in St. Louis, and then completely reinvented the building? Let's just say it's in the right location. Someone might actually prefer that versus your brand new shiny glass and steel tower. And I might even go so far as to say that the person who buys that out of foreclosure, despite whatever they might spend to remodel the building extensively, of course, might be able to outcompete that other new construction all day, no matter what that new construction building can offer. And so Tucker's point, like, we have way too much supply across America right now. It's only going to increase. I can guarantee you that, as leases start to roll and people start to right size. And so I think that's an anomaly we all need to be aware of, and developers need to be aware of, is that, you know, rather than build a building, maybe it makes more sense to buy one that's, you know, almost vacant or entirely vacant and reinvent it.
There's a lot to unpack here. A new term, trickle-down demand, is where I'm going to go with this. It's not the expectation that more supply will be built. I think the market, based upon some of the comments I'm hearing, is banking on the lack of available options in this premium office space category to push the demand back into the core office space category, or the core A space, to try to create more demand, right? So it's a way to put a shiny outlook on the market to say there's at least a very strong amount of demand at this segment. There's not enough supply. The likely scenario is that they will have to lease something, and it'll push them back into more of the core assets. So that's where I see, you got to know your audience. KKR, real estate, you know, the Blackstones of the world, the JLLs of the world that have huge investment portfolios of owning real estate. Then you look at the flip side, right? So you've got $1 trillion in loans expiring this year. Sounds like a really big number. Well, what's interesting about it is at the end of 2023, there was, or at some point in 2023, there was $600 billion in loans expiring in 2024. So how do you create $600 billion to $1 trillion in the same year? You don't make $400 million more loans. You kick the can down the road. So in 2023, a lot of these owners said, okay, we're going to renegotiate. We're going to add a year extension or a 2-year extension on our loan. Let's see if 2024 will get a little better, because now my loan's due a year later. So everybody's banking on an improvement in the marketplace to be able to refinance their loans. I think higher for longer with interest rates is really, really struggling, is really impacting that outlook. But I think you're just seeing people that are just hoping and praying that this one shining bright spot will have an overall impact on the marketplace that probably won't come.
Yeah, and I just don't think those that kick the can down the road, things aren't better now than they were a year ago. That was the hope, that interest rates would start to drop. The Fed's has been holding steady. Obviously, the job market numbers last week gave people hope that the Fed would lower rates later this summer, which is why you're seeing the surge of in the market last week, including today. But I just don't think that you're going to see much material difference. And the difference between now, like we've talked about in previous pods from 2008, is that 2008, we didn't have work from home. People were going to come back to the office eventually. And even though vacancy surged throughout America, it wasn't because of work from home. It wasn't because of a pandemic. It was because we were in a recession. Okay, Seattle had 30% vacancy overnight, and then it quickly rebounded very quickly, like a whipsaw, due to a tremendous amount of leasing that occurred in 2009, 2010. if I'm a lender right now, I don't have much optimism. And basically you're just praying that rates come down, but you don't have the hope or any sort of confidence that the demand will come back. And that's what creates successful buildings, is having demand, having leasing done generates NOI, net operating income. There is none for a lot of these owners, or very little to be had, even if they are able to retain tenants. So I think today, unlike the previous recession, and I've been through 3 recessions, this is my 3rd recession, by the way, I don't see much hope for these continual 1-year extensions on loans. Because I don't think rates are going to come down significantly. We may see some correction later this summer, but the demand's the biggest one. And we just know that that's not going to come back to the extent that it needs to.
Yeah, I don't know. I was in the same camp as you on the extensions of these debt maturities, but I don't think there's an alternative right now for anyone that's palatable. So if the owner will continue to hope and pray, the lenders will probably allow it, because they don't want the buildings back in such a terrible market. I mean, the fact of the matter is that vacancy rates are off the charts, availability rates are off the charts, and those 2 metrics to me, I think, are useless right now. I think the only thing that matters in my mind for any of these markets is occupancy. If you have occupancy rates that are sitting at or below 50%, you're going to see a massive amount of space back on the market in any category. I mean, financial services is the only bright spot. And I was reading one of these earnings releases, and they did talk about financial services is leasing activities up 20% year over year. So that segment of the market in locations that are heavily weighted towards financial services may see some strength in that market. But I can't think of, like New York used to be. Maybe there's pockets that are in New York that can bounce back faster than others. But there's so much tech in New York. There's so much life science in New York. There's so much diversity outside of financial services in these markets that I don't even think the demand is big enough, and the market's too big to even make a sizable impact in the New York City market overall. So it's bleak for owners, and I think they'll just keep kicking the can down the road because there's no other way.
Yeah, one comment before then I'm going to shut up, and John, you can and Tucker, I would love for you guys to opine. But Brian, the one thing about kicking the can down the road that gives me concern of that continually happening is that these owners' equity has been just absolutely decimated in these buildings. And in some cases, I've been talking to lenders, in order for them to kick that can, they need these owners to rebalance these loans. Well, with the owner's cost of capital and everyone's cost of capital rising so significantly these days, the question is, do these people even want to put in additional money to help kind of rebalance that loan such that the lender will even do that 1-year extension or 2-year extension? So that's a big thing to question too, is do these owners even have faith and optimism in their own assets such that they're willing to kick in a few $1 million, in some cases tens of millions of dollars, to rebalance in order to hit those leverage points in order to get the refinance to actually occur?
Yeah, I think if it's a refinancing with balancing, there's a lot more buildings that come back. But if you just take the existing loan and change the date to a 3 to a 4 or 4 to a 5, and everybody just keeps paying, as long as they're making their payments, right? And the owner is current on the loan, the banks are saying, okay, well, we could force a refinancing by calling the loan, and we're likely going to get the building back because it's worth 40% less than what it was worth when we did the loan. And you're seeing a lot of those. You're seeing more and more. But far and wide, they're saying, we're getting income on this loan. It's performing. Let's just extend the maturity date and continue to take payments on it without any, without any hiccups, and see what happens in next year. That's why $1 trillion went to 400 or 600 billion went to $1 trillion in maturities in 24, because they didn't call the loans in 23. They just extended them. So I agree with you. If they do, it'll be a significant increase in defaults and in banks taking possession of assets at that point.
I want to challenge one thing you said, Brian. This idea that, as long as we're sitting at 50% and below occupancy, the market's going to languish and whatever other bad things are going to happen. So What if 50% occupancy of our office buildings is the new equilibrium? What if that's the new normal in the world of hybrid, right? I mean, is it, do we really think we're going to get back to where, and even in the peak, we weren't, much above 50% actual utilization and occupancy. I mean, our office buildings sit empty a lot of the time, even pre-COVID. And they're just going to sit empty a little bit more now. So maybe that's the new normal. I do think if that's the case, maybe we're not willing to spend quite as much for these beautiful office buildings that are sitting empty. But the idea that our people are learning how to be productive in other places, in other ways, and maybe 50% occupancy is here to stay. What do you think?
Well, I think just to restate this, I think 50% occupancy across all sectors is here to stay. It is the new norm, and it will not change. Today, we're at 50% occupancy under the old way, which was sizing and creating an office environment sized for 5 days a week, 70 or 80% occupancy. I would challenge you that, in many cases before the pandemic, 50% was the norm. It wasn't. It was more like 70 and higher for financial services, 80% maybe. I think what will happen is because people accept this hybrid environment, they're going to change their real estate footprints considerably. People will get less space. They will become more efficient, and companies will right-size their portfolio. So 50% becomes a target for a hybrid environment in 3 days, which is a much smaller footprint, I believe. I think companies are going to say, okay, we're going to do this, and we're going to make the environment more inviting for the limited amount of time people are here, but you're not going to get permanent or dedicated space as an employee that shows up 2 or 3 days a week. So I think there's going to be a massive amount of space that gets returned to the marketplace as these expirations work themselves through. That's the difference between before and after, John.
Yeah, I think we're also, John, besides just the lending, and I mean, this 50% occupancy in downtown corporate America would have a massive impact on the reshaping of the city. That would change the way we urban plan. And it would reshape the entire landscape and societal dynamics of what is a downtown. And so if that is, or is becoming rather, kind of the future of cities, we need to pivot, and our urban planners need to think about this now, not when it is upon us, because we're going to see decreased property values across the board, which is going to reduce tax revenues. And then what happens to local businesses that are downtown? What happens to our public transit systems when there's reduced ridership? If people aren't coming to downtown. So this is like a whole nother podcast discussion, but 50% occupancy in downtown America would massively reshift the way downtowns look. And I think the smartest cities, if that is what we are becoming, are already working on that what if scenario now, or I hope they are.
If you compare and contrast, so doing work in two cities, New York City and San Francisco right now, and you don't really realize it until someone tells you it and you pick up on it. But New York, people live in New York City. They every other building's a high rise. People walk to work. The city is busy outside of working hours. Go to San Francisco at 6 o'clock in the evening. It's a ghost town. You got tumbleweeds going down the street. It is a commuter market. People commute into what's left of them. But even before the pandemic, it was a market people commuted into, went to work, and then they went home outside of the city. Until that flips to a New York type model where people are living there and becoming part of the ecosystem, I don't know how cities survive under, the current configuration. So massive amounts. I think this creates the opportunity. I'm changing my opinion on the conversion of office to residential. I think this is it. We're at a pivotal point in history where we can reinvent our cities and take 50, 40, 30% of the stock of these old office buildings and turn them into residential, or just knock them down and put up high-rise residential, get people living in our cities again. And we won't be having this conversation because there'll be less stock. All of the older product won't be there. And you'll have a 24-hour or at least, an 18-hour day where all the retail can survive, all the amenity type spaces can survive. All of that was based on office employment before. which just doesn't allow it to survive in these cities. And now the cities are falling to the wayside. Be like New York in the sense of put people down there, live there. And when we have an opportunity to do that right now because no one's going to go back to these Class B or A- buildings. So get rid of them. And sorry for all the owners that are out there. It's $1 trillion worth of assets gone. But, too bad, so sad. We want our cities to thrive, and that's how you do it.
Too bad, so sad. There's the other side of that coin, and I agree, by the way, and that's what we've been talking about and sort of rethinking the way we work and rethinking civic design and urban downtowns. Yeah, I agree with you. More residential downtown. So you have a blend of office and folks living in the community and shopping and spending money in retail. The flip side of that is let's send some of those jobs to the suburbs. You're going to see, new office buildings or successful office buildings in suburbs closer to where people live. Both are accomplishing the same thing, bringing people downtown to live or taking office jobs to the suburbs where the people already live. I think you're going to see that scattering of the jobs away from a singular central stacked downtown office where everyone goes to work. We've been saying that for some time, but there's two sides to that.
I think there's a big difference though, John. No, people, especially in markets like Boston that had these old tech companies in the suburbs. I think the way of the suburbs, as most of our listeners view them in their mind, is over. It's dead. The single office park with 3 buildings and a little cafe that you have to drive a half an hour, 45 minutes to get to. You go to work, you have to get in your car to go get a sandwich at lunch or go, drop your kids off at daycare that might be in the park or it might be 2 parks over. No, that's dead. I mean, people don't want that. What they want to do is go to an suburban urban environment where it's these lifestyle centers that have retail, that have residential, that have amenities and have offices all built into one. They're large population centers condensed into these easy access, probably at the intersections of major thoroughfares or at a commuter train stop built into it, but they're just not in the city center. I think those are going to flourish. They're going to create layers of residential that expand beyond them, and you're going to have a reshifting of the population centers around these types of environments. But the old suburban, single 2-building, 3-building campuses that the old tech companies that the EMCs built in New England here, or digital equipment buildings. I mean, people are still populating deck buildings that were built in the 1970s in Western or kind of 495 belt of Boston. Those buildings have ribbon windows, the light penetration's about 4 feet off the window line. It's awful. Right? No one's going to work in those either. So it's not just get to the suburbs. It's got to be new. It's got to be space that brings people a different experience than it's ever brought them before. And that's why they're talking about this Class A plus having, oversized demand or very little supply available. It's because people don't want that old crap anymore. It doesn't matter where it is.
I think Brian's stuck on this suburbia lifestyle of those akin to those buildings along the 495, but there are some nice suburban campuses. So I don't want to suggest that that's not the case everywhere. Maybe for Brian's market in Boston, but John, I think the reason I think if downtowns across America can provide people a safe place to work, safety is paramount, and clean. Okay. Assuming those 2 boxes are checked, I think by and large, on the aggregate, downtown's a win. And the reason I think that is what they can offer that a suburban campus can't is lifestyle and vibrancy. Just think about the cultural activities of being downtown. Think of all of the museums and theaters, art galleries. I mean, the list goes on. It doesn't mean you're going to go to an art gallery at lunchtime, but that just attracts visitors and tourists and vibrancy that kind of infills the cities during normal business hours. Think about the social scene. Nightlifes, bars, after-hour drinks, lunch at noon with clients, music venues, sporting events, etc. You don't get that in suburbia either, by and large. And then finally, just like diversity, you get a much, much more diverse population downtown, creating that tapestry of culture. I think that a lot of companies are looking to enhance into their workplace. So it doesn't mean, again, like, I don't think there's a one size fits all solution for everybody, but I think if downtowns, generally speaking, are safe and clean, they win on the aggregate.
I agree. I think that's really well said. And here's what I would suggest. I believe that the vibrancy and the lifestyle and the experience of that humming downtown was a secondary effect of us stacking all our jobs there. Wouldn't it be cool if as we reimagine our urban centers, that with intention, we're including some residential, we're designing those parks, we're designing those places of interaction, the retail, the theaters, the arts and culture elements. I believe those came about as a secondary effect. They weren't necessarily intentional. We just had these stacked jobs downtown. So maybe going forward, that's part of civic design in anticipating that vibrancy of a lifestyle in the design of the downtown. And I agree that it's a cool place to be when it's humming.
I always like to put my tenant rep lens on with these conversations and bring it back to the earlier question, Tucker, that you had asked around what our thoughts were on this Class A plus product type. I just want to bring people's eyes or ears to when I was reading CBRE's first quarter, the use of a word. So Robert Solinek, the CEO of CB, uses the sentence, leasing outperformed expectations driven by office leasing growth globally that reflects a resilient economy and companies making progress on bringing their employees back to the office. Progress. He thinks companies getting their people back into the office more is progress. Then you flip to the CFO, Emma Giamartino. She says talking about leasing revenue. Leasing revenue rose in every region, and global growth exceeded expectations. Office leasing grew by double digits globally as a resilient economy again, and progress on returning to office plans have emboldened tenants to make occupancy decisions. So it's funny that one of the largest, or actually the largest real estate advisory firm in the world uses the word progress when it refers to companies bringing their people back. While in my mind, it doesn't matter if people stay home or go to work. It's finding the right balance that fits for that company. And our outlook isn't tied to, or our success is not tied to people coming back to the office. It's tied to helping companies make the best decisions on what that mix is for them. But if you start to think about the JLLs, the CBs, the Cushmans that have so much of their future riding on the success of landlords, progress in getting people back to the office is a big part of the underlying message they deliver to the marketplace on their success as a company, as a public company. So it's interesting because that to me is in conflict with helping tenants make the right decision. The right decision doesn't mean we're going to have progress about bringing our people back. It could. The right decision might be just finding the right balance that works best for them.
Well, just think of who they serve. And you have to, if they were more grim in terms of their outlook versus suggesting there's progress being made, do landlords want to hire them? So think if I'm trying to sell my house right now and I meet with a realtor and the realtor tells me about how slow the market is, mortgage rates are 7 to 7.5%, even for someone with decent credit. Even if someone has an 800 plus credit score, they're still looking at a seven digit mortgage rate. That if we don't have our house in the market by, the next few weeks, we're going to miss that surge in May and June, blah, blah, blah. Do I want to hire that person? Or do I want to hire somebody who's like, yeah, they're 7%, but you know what? Your house is perfect for this buyer. And, these are all the transactions I've closed. And, for who cares about mortgage rates? Seattle is still a humming city. There's a lot of demand, et cetera, et cetera. You just have this, I don't know if I would call it confirmation bias, but you want to work with people that have optimism. I don't want to work with people that, falsely paint a ridiculous sense of reality. But I guess to Brian, your point, anytime anyone's saying anything, and I don't want to call out any of the big firms versus any other company, but just know who their audience is that they're talking to. And I think when you frame it in that sort of context, you get a sense for why they're choosing the words they're choosing.
Yeah. And all of these investor updates related to real estate companies, whether it be a brokerage company, whether it be an institutional landlord, there is a fair degree of pandering that's going on to the investors, taking the more optimistic lens around what the future is. I mean, there was a company, big brokerage firm that we mentioned, it was probably now a year ago, and they were talking about how optimistic they were for capital markets transactions in the second half of 2023, that they anticipated there was going to be like triple the amount of transactions that they had in the first half. And of course, it was nowhere near that. Yet people are saying this as a publicly traded company on earnings calls, and it's their forecast. And as we all know, often forecasts are wrong, including forecasts that the four of us have made being wrong, right? What's important is trying to be as realistic as possible and updating the forecast as soon as you have new information. But yeah, Brian and Owen, I completely agree with you. For one, progress doesn't necessarily mean, hey, the end state is that we're back to normal office occupancy in the US or globally. Like that should not be the end goal here. That might be the end goal for one particular company where that's the best thing for their business, but it's certainly not the right thing for all companies. And Owen, you're absolutely right. There's a lot of sort of massaging and pandering of what is actually happening. And it's not as if I think there's any like bad faith, like puffery or being overly optimistic in a nefarious way or something. I genuinely believe that people that work in these environments that are serving 80-90% landlords are drinking the Kool-Aid so heavily and thinking that everything's going to be okay because it's so much in their best interest to do so. And of course, most people that are in the brokerage industry are optimistic, right? But they're almost drinking their Kool-Aid too much. And I don't think that they are realizing what is actually going to happen in all cases. And being able to stay objective about this stuff is really important. And it's hard to do when you're talking to, Blackstone and, these giant institutional landlords every single day that are trying to pander to investors and stay optimistic and, keep their employees that have carried interest in their fund engaged and thinking that their carry is going to be valuable so they don't leave the company. And I mean, there's so many reasons that people take the optimistic side of this.
On that point, if you go into the marketplace with a client right now and you do, you're a good broker and you know what you're doing and you create a long list to a short list, right? You start the funnel and you make sure that you see or put in front of your client all the options and let the client, with your guidance, down select to a tour list and then ultimately an RFP list, right? So you do all the homework, you start wide, and then you go to market. You are likely, I'm finding, and say that's half a dozen buildings, maybe a dozen if you like to see buildings. You're likely to get equal or more non-solicited proposals from buildings that you eliminated prior to touring than buildings you actually tour and request proposals from. That's how much the marketplace is just looking at any demand and trying in any way possible to get you to focus on their asset, even if it's one that you've made the decision not even to tour, in conjunction with the goals and objectives of your client. So that gives you any sense. So, 6 building tour, get 12 unsolicited proposals. That's the way it is right now. And those are real stats.
I think this is a good segue to this article, and we already are pretty deep into this podcast, so we'll try and do this quickly, but it was pretty profound. There was an article in the Business Insider written by Bethany McLean about BREIT, and it was a really scathing kind of takedown of BREIT. And she needs to be taken seriously. So I'm reading from, and then ultimately these guys at CRE Analyst did a whole deep dive on all the claims made and sort of refuted some, acknowledged some. It's like 36 pages. It's really worth reading. It's a super interesting question. But anyway, Bethany McLean, about her, 25 years ago, Bethany McLean pulled back the curtain on Enron. A 20-something journalist with a few years of iBanking experience broke the biggest corporate fraud in history. It's an article called Is Enron Overpriced? Then she wrote The Smartest Guest in the Room, which became a critically acclaimed documentary. In short, McLean is a generational talent. And she's trying to take down BREIT. Wow. Okay, but these guys at CRE Analyst do a really sober and thorough job. Some of the claims that they take on claim. In recent months, I've spoken with veteran analysts, accountants, and this is from the Bethany article. Spoken with veteran analysts, accountants, and investors who have come to believe that BREIT is essentially a house of cards because the returns the fund claims it has delivered depend almost entirely on BREIT's own estimates, which skeptics believe are wildly inflated. Wildly inflated. It's pretty much hyperbole, a lot of hyperbole. What's more, when BREIT faced a flood of redemption requests from investors, it only fulfilled all those requests after raising cash from new investors, including one that received a sweetheart deal. It was preferred shares they received from Blackstone in order to invest in BREIT. I'll give you one more. Faced with a run on the fund, Blackstone cited a provision that allowed it to take its time refunding antsy investors, a decision that only served to further alarm the market. And these guys go on to point out they're allowed to do that. It's in their perspective, this idea of a queue for exiting the fund. So it's just so damning. And I'll kind of cut to the end. And these guys at CRA Analysts kind of give it a final score. Yeah, some people don't like Blackstone and think BREIT is a house of cards. Some people think that. BREIT didn't generate enough cash to cover its dividend last year. Yep. BREIT doesn't include some expenses when calculating distributable cash. Yep. So all these kind of points. And in summary, they go on to say BREIT isn't Enron. Parts of the Enron article sound very similar to this week's House of Cards claims against BREIT, but BREIT is different. Complex, yes. A lack of detail around specific investments, sure, but a Ponzi scheme or a fraud? Enron was booking decades of speculative future energy revenues and had billions in undisclosed off-balance sheet debt. BREIT invests in high-quality properties and is limited to 60% debt. It has demonstrable income that is passed through to investors. Your dividend isn't high enough, doesn't have the same ring as you're cooking the books. So really, really interesting article and a really great, as I say, sober summary of the facts by these guys at CRE Analysts. So dig into either of those if you can find them.
I think that there's a reason that this was published on Business Insider instead of in the Financial Times or Wall Street Journal or something more reputable. Comparing BREIT to Enron as is just so silly, right? Like, this is the largest private equity firm in the world. BREIT has had some of the best returns of any real estate investment you could have made over the last 15 years. Blackstone has very consistently been the smartest people in the room in terms of very large scale real estate investment, whether it be what they did with, Equity Office in 2008 and that investment, and selling the whole portfolio in parts and pieces and making 30% on their money in probably the worst environment you can own office space in, apart from the pandemic. And a lot of these things that are being cited in that article, which I read too, are very customary in terms of private REITs, right? One of the challenges with any type of investment vehicle that is investing in fundamentally very illiquid assets is that if there are major macro shifts and people want their money back, then you have to have redemption clauses to protect the investors that are long term. You can't have 20 or 30% of the fund run for the doors and then fire sale a bunch of assets at a bad time without really negatively impacting all of the investors, even the ones that are long-term in focus. So, I mean, the reality is that if you think of the prominence of BREIT, basically anyone that works with, a private bank or any, like pension fund, life insurance company, endowment, all these people have provisions in Blackstone, and they have access to levels of diligence that sort of retail investors probably aren't going to get. Like, not saying that they have like non-public information or something, but they have the ability to do additional levels of due diligence. And the probability of Blackstone, largest private equity firm in the world, doing something illegal is just, I think it's very low. And again, that's why they published it in Business Insider, which I think people in the business community have come to the consensus has a fairly long track record of publishing absolute garbage.
Yeah, I think they're onto something in a small way around the REITs process for repricing assets on their books, right? There's a reluctance for, and this isn't just BREIT. I think there's a reluctance for REITs to keep up with the repricing of assets so that they accurately reflect the value of the underlying investments. When you have a long-term investment, I see both sides of it. When you have a long-term investment, who really cares what the current value is unless there's redemptions that require you to resell it? If you've got restrictions on redemptions, there's no reason to reprice it, because if it's cash flowing or you plan on owning it, who cares what it is worth today? But there is a game that they play to artificially inflate the value of assets in these REITs. And you see it across many, many REITs. There was one here many years ago. There was an activist investor uproar around the fees. It was RMR Group. There were fees that the holding company or the management company was charging, which was the kind of umbrella on top of the different REITs underneath it, and the pricing of the assets and the value of the funds underneath them. So I think they're onto something there, but honestly, Business Insider has lost all credibility in the market. If you follow some of the stories it has published recently, particularly very recently, it has zero credibility left in the marketplace in my mind.
Yeah, I wouldn't have read that article in Business Insider if John didn't mention it, because I think that they have a really low level of standard for reporting. And a lot of this stuff is very misleading, whether it be the title or the body. And the CRE analyst people, I think, are very smart in how they look at these things, and also have an understanding of a very complicated corporate structure, right? Like REITs are complicated vehicles, whether you're a public REIT, whether you're a private REIT, whether you're a private non-traded REIT, right? Like there's so many different variables to how these are set up, and they're a bit arcane in how the tax treatment of earnings and funds from operation and the different metrics that people use generally to value REITs. But anyways, that has been a very full and fun episode. Thanks so much, everyone, for listening, and we'll be back with episode 36 soon. Thanks.